This is a case that's in the textbook, and I took a screenshot of it and put it in here. Nola wants to start a business. She invests $1,800 in the company. That is our first event. So let's call this owner investment. How are you going to put that in? The first row.
In cash,
18,000.
1800.
All right, in cash. So plus 1,800 and what's the other side? Because remember, every transaction has to have at least
in common shares.
Common shares. That's right. Okay, so common shares plus 1,800 and balanced. Excellent. Next, so we keep reading. Okay, her parents lent the company $3,000 to help get it started. And Nola wants to pay interest, so her parents are going to charge interest on this loan 6% per year. So what we're going to do is we will save that 6% per year just until a little bit later, but let's get this $3,000 in the system. So I'm going to put a little check mark there that we've entered the 1,800, and now let's deal with this 3,000. So how do you think that $3,000 should be recorded? Let's call it loan from parents. How would you record this into our worksheet?
Cash.
Cash, okay.
Cash
plus 3,000 and what else?
And loans.
Loan
parents 3,000.
I love everybody getting involved. This is so great. So loan from parents plus 3,000. All right, we continue on here. Nola negotiated purchase of a car. So the company makes a down payment of 3,000 and finance the remainder at an interest rate of 9%. All kinds of kilometers on the car, and she estimates that the car could be sold at the end of the summer for $6,000. So what we're going to do is we're going to save the interest. We're going to save that till later, and we're going to save the $6,000 until later as well, okay? So let's deal with the $8,000 for the car. So purchase car. And she's buying the car for her business because she's in the courier business, right? That's what she wants to do. So to set up a courier service. So how do you think this transaction will go into the records? 3,000 minus cash, because it says down payment of 3,000. So a down payment is basically you put some down and the rest is financed. Financed means with a
loan from the bank.
Loan.
No, account payable.
Oh, no, not accounts payable. Accounts payable we reserve for what we call trade activities or trade payables. This is a specific loan.
Loan.
Okay, so how much for the loan?
5,000.
So 5,000. That's going to be plus or minus 5,000?
Plus 5,000.
She owes more, so it's plus, right?
Well, if I look at this line, I have 3,000 minus on one side and 5,000 plus on the other side. Well, I don't balance. My universe isn't in balance. Oh, no.
8,000 in auto.
Plus or minus?
Plus.
Exactly. So you see what's happening here. We have the car going up by 8,000, which is an asset. Cash goes down a little bit, 3,000. So that means the net change in assets is plus 5. That's on the one side. The car loan plus 5. Everything in balance now. We love to balance. Now we can move on to the other individual transactions here. So she started the operations in May and went until August. Okay, she didn't keep any formal records. So during the summer, company made payments on the car of 623, which includes interest of 123 and principal of 500. So let's call this car payments. How do you think this will get entered into our schedule here?
Minus 623 from cash.
Okay, excellent. Minus 623. Okay, what else? Somebody said interest. What about the interest?
It's 123 negative. On the other hand, interest payable.
I'll agree with you on part of that. There is interest of 123 because that's what it says. But this is not interest payable. Because the payments, or the car payments, have already been made, and the payments include interest. Payable means you will pay in the future, but those car payments were already paid. So it's not interest payable, it's interest expense. And that will go in the retained earnings column because an expense is the cost of something. Interest is the cost of borrowing money. So we have to record the cost of borrowing the money as an expense. That's what interest expense is. So expenses cause my retained earnings to go down, which causes my equity to go down. So that's 123 negative in the retained earnings column for expenses. So that takes care of the interest piece. But now my line is still not in balance, right? I got 623 on this side and only 123 down on this side. What's the rest?
Minus 500 from loan auto.
Loan,
Yes.
the 500.
Minus 500 here. So the auto loans, see, this is the principal portion. Remember, principal is the amount of the loan. The payment includes principal plus interest. If we did not make an interest payment, then we would calculate interest payable on this, and you would be correct. But for the car loan, the interest has actually already been paid. So now our line is in balance. But since we're talking about this interest business, look at the next item here. It says there were no payments made on the loan from her parents. But this doesn't mean that we don't do anything. If you take out a loan, you start to accrue interest. The interest clock starts ticking as soon as you take the loan. This is an example of accrual accounting. Nola here borrowed the money from her parents. She hasn't paid her parents yet, but has she been incurring the cost of borrowing that interest money from her parents?
Yes.
Yes. So accrue interest on parents' loan. How do you think this is going to look? First of all, let's calculate it. So this is also going to be interest expense, right? So, but this is a different interest expense, interest on parent loan. How do you calculate interest? You guys remember how to calculate interest from high school or wherever? How much is the principal on the loan? How much does she borrow from her parents? Isn't that 3,000?
3,000.
Dollars, yeah.
Times 6% is $180 per year, because interest rates are always quoted annually. But now we have to multiply that by 4 months divided by 12 to get 60. So the total interest accrual will be $60 in interest expense. So an expense, right, because I'm recording the cost of borrowing the money from my parents, even though I haven't paid them yet. So my line still doesn't balance. How is this going to stay in balance?
Interest payable?
Yes. And so that's going to be what, plus 60 or minus 60?
Plus 60.
So see, this transaction is confined all on the right side, isn't it? So you can have things go up and down. They can be on one side. That is the accrual on the loan. Okay, so now we've taken care of that one. So the next one, Nola paid herself a salary of $1,500 per month for 4 months. Nola salary. How's that going to look? How are we going to record that?
Minus 6,000 from cash.
Minus 6,000 from cash.
Excellent. Minus 6,000 from cash, right? So, and what is the other piece?
On the other side, it should be in retained earnings. Minus.
Excellent. And we'll call this salaries expense, right?
One question, why is it 6,000?
Because she pays herself $1,500 per month, but
yeah.
she was in business for 4 months. And then we have payments for other operating costs, totaled $9,600. But in addition, unpaid bills of $100. So let's call this description operating expenses. And how is this going to look? How are we going to record this?
Minus 9,600
For where?
under cash.
Yeah, why cash? Minus 9,600. Because they were paid. When you see paid, payments, paid literally means paid. Okay, and we pay everything in. When we say cash, that could be, it could be cash. It could be electronic transfers from your bank account. It could be checks. Okay, so in the accounting world, when we say paid in cash, we mean that we've used a cash balance in a bank account or something, or even cash. So 9,600 in operating expenses. Okay, what else? Because this thing isn't finished.
Accounts payable.
$100.
Accounts payable for how much?
$100.
$100.
Plus
$100 plus 100. And then what? Because it doesn't balance now, right?
It's minus 9,500
Minus
from retained earnings.
Minus 9,500?
From retained earnings.
Okay, I'll give you the retained earnings, but is your number correct, sir?
Minus 9,700.
9,700. And we can call this operating expenses, okay? And this is also part of accrual accounting. So 9,700 is what we are recording as total operating expenses. 9,600 paid now, 100 pay later. Courier charges collected from customers total 19,200. And in addition, customers still owed 300 performed in the last 2 weeks. So these are basically her revenues, courier revenues. How are you going to record this in the system?
19,200 add in cash.
Okay, 19,200 cash. Excellent. What else? 300 accounts receivable. Accounts receivable to be received in the future. Not balanced though.
On the other hand, it should be retained earning plus 19,500.
Excellent. And we call this revenues. Now that's all that's listed here. Now the one thing that we have left here is this $6,000 that's mentioned in here relating to the car. The reason why she bought the car is to be able to earn revenue from doing the courier stuff. And of course, the car, because it's being used, will end up losing its value slightly over time, right? She's using up the car. But we call something like a vehicle or a factory, any big expenses, we purchase them to generate revenue over time. So we call those long-term assets. They generate revenue over the long term. So what we have to do is spread the cost also over the long term. Because she's now going to sell this car, she expects to stop doing business at the end of August. She's going to sell the car. The original cost of the car is $8,000. And she expects there to be a $6,000, we call it residual. Well, that's a difference of $2,000. We can call this the depreciation. This is the change in value of the car over the period of time that she has it. And when most people think of depreciation, they go, okay, you buy a new car, as soon as you drive off the lot, it drops in value by a certain amount of money. That's not quite how accounting depreciation works, okay? And we'll get more when we get to the right chapter of it, but nevertheless, that's what this is talking about. So we could say that there's depreciation expense here of 8,000 minus 6,000. That's where you get 2,000 from. And because it has the word expense in it, we know that that's going to be negative 2,000 in the retained earning column, right? But it doesn't balance. My line doesn't balance. Where is the rest?
Minus 2,000 Minus auto. 2,000.
That's right, minus 2,000 the auto. So now we're all said and done here. Don't worry about this last piece here. It says at the close of business, there was a balance in this item number 6. We'll talk about that in a few minutes. I just want to save it. So now we can total everything at the bottom. So I'm doing the heavy lifting for you. 477, 300 in accounts receivable, 6,000 in automobile, 11,077, and we can say that this is total assets. And same thing for the other column, 163,000, 4,500, 1,800, and 1,617. And these also add up to 11,077. This is total liabilities plus shareholders' equity. So now we have everything we need to create our first 3 financial statements: income statement, retained earnings, balance sheet. The name of the company is Roadrunner. An appropriate title for an income statement is the name of the company, the name of the statement, and this is for the period of time. So an income statement is always for a period of time. So this one is for the 4 months ended August 31st. This is very important because this tells your reader what period of time this is for. If you don't include any of this stuff, well, how the heck does the reader know? Is it for 6 months? Is it for a year? Is it for 9 months? I got no idea. You have to tell me. And you also have to put my name on it so that I know it's for the company and the type of statement. If you don't tell me it's an income statement, how do I know what the heck it is, right? You know, it's very important. It's a very small detail, but it's a crucial detail, okay? We can now put this into context and say, okay, let's get this down. I have revenues and I have expenses. I have my interest expense for the car. I have interest expense for the loan. I have salaries expense. Then we have operating expenses and depreciation. And I'm just going to pull from the worksheet we just had. Isn't my revenue 19,500? And aren't my expenses 123 on the car, 60, 6,000, 9,700, and 2,000? And doesn't that make total expenses equal 17,883? So I'm just doing a subtotal for my expenses. And isn't revenues minus expenses is net income? And that is 1,617. The next statement is retained earnings. That's what a statement of retained earnings looks like. The only difference from an income statement is the name of the statement. It also is for the 4 months ended. And the retained earnings statement starts with the beginning, retained earnings, on May 1st, and we add net income. Right? So our May 1st beginning retained earnings is what? It's 0 because the business is new. So there is no beginning. But I add my net income of 1,617, and that gives me a subtotal. And then we subtract dividends. What are the dividends declared in this case?
0.
0. Didn't declare any dividends, right? No DD anywhere in here. So that means our ending retained earnings on August 31st is 1,617. So that is our retained earnings statement. Last, we have a balance sheet, or what's called a statement of financial position, okay? Because that's the other thing we're asked to do here. And you can call it balance sheet, you can call it a statement of financial position. That's totally fine, okay? And we get our accounts from all of our categories in the table. So I'm going to start with assets. And under assets, I have cash and accounts receivable and auto, right? And how much is my cash? 477. What's my accounts receivable?
300.
300.
It's
That's
300.
right. You see, now you get it. 11,077. We can call this total assets. Then we have liabilities. And for liabilities, we have accounts payable, right? Interest payable. Now, this parent's loan, it's probably better if we call it like a note payable. $100 in AP, 60 in interest, 3,000 auto loan, and that is 4,500. So now I have total liabilities, and when I add those up, 7,660. And then I have my last section on the balance sheet, which should be what?
Equity.
Shareholders' equity, and that consists of common shares and retained earnings. So the common shares is 1,800, and my retained earnings comes from my retained earnings statement over here, 1,617, which means my total shareholders' equity is 3,417, and total liabilities and shareholders' equity, that is 11,077. And look at that, the whole thing works and is in balance, and we are happy now. And there we have all of our completed financial statements.